In April 2026, the cost of carrying unsecured debt is punishing. The average credit card interest rate sits at 25%, while 67% of Americans are living paycheck to paycheck. When a borrower tries to lower that rate, they run into a massive information asymmetry. Banks employ highly trained retention teams, armed with deep data on consumer behavior, all optimized to protect their profit margins. On the other side is the consumer, trying to negotiate while carrying an average balance of $6,000. They are forced to navigate confusing phone menus and endure 40-minute hold times just to speak with someone. I realized I was losing money simply because I didn't have the time or patience to sit on hold and argue. I decided to stop doing these digital chores manually. I deployed an autonomous execution agent. It is a piece of software that lives on my phone and conducts business on my behalf. Deploying this agent changes the nature of the interaction. By removing the barrier of human exhaustion, the software targets the specific mechanism of friction that banks have used to maintain their rates for decades. The setup connects my financial accounts through open banking APIs. The agent pulls in credit cards, checking accounts, and loan histories to build a single debt map. The system then scans that data for leverage points, instantly spotting a 24-month history of on-time payments. Before the agent does anything, I have to set digital leashes. These are strict parameters that tell the AI exactly what it is allowed to agree to, ensuring it doesn't accept terms that might hurt my credit score. For this negotiation, I instructed the agent to target an annual percentage rate of 18% or lower, the statutory ceiling for federal credit unions. The AI then calculates its best alternative to a negotiated agreement, or BATNA. It instantly sweeps the current lending market and finds a 21-month 0% balance transfer offer from a competing bank. Armed with my payment history, a hard target of 18%, and a 0% competitor offer, the software has mapped out a path to a result before it even dials the number. The execution agent places the call. Its first obstacle is the bank's interactive voice response system, which is actively screening for automated bot callers. To bypass this, the software operates with sub-200 millisecond latency. It responds to prompts smoothly, mimicking the pacing of a human speaker. It uses hyper-natural voice synthesis. The agent generates subtle breath sounds and strategic pauses, convincing the security software a real person is on the line. Then comes the hold music. While a person might hang up in frustration after 40 minutes, the AI sits there indefinitely. It feels no fatigue or impatience. When a human retention specialist finally picks up, the agent presents my 24 months of perfect payments and requests the rate reduction. If the representative hesitates, the agent deploys its leverage. It states clearly that we have a 0% transfer offer ready and will move the entire balance to the competitor if the 18% rate isn't met. The software effectively corners the representative. It weaponizes an infinite attention span and perfect data against a human worker bound by call time quotas. A few minutes later, a notification pops up on my screen. The bank dropped the rate to 18%. On an average $6,000 balance, that is an immediate savings of $420 a year. Because this involves a contract change, the process requires a human in the loop. I review the offer and provide a cryptographic signature to finalize the agreement. These AI services typically use a pay-on-success model. The developer only gets paid if the negotiation works, removing the financial risk of trying the service. When this happens at scale, it represents a direct threat to traditional banking revenues. Millions of dollars in interest are being stripped out of the system by automated proxies. Financial institutions are responding with defensive AI to detect synthetic voices and using the Computer Fraud and Abuse Act to limit these bots. Look at this white paper from the Consumer Bankers Association. The industry is drafting new frameworks to handle the surge of agentic payments and automated disputes. This is why mandatory digital kill switches have become a defining requirement. If an agent goes rogue or attempts to bypass security controls, the session is terminated instantly. Personal finance has shifted into an always-on, autonomous process. Software now handles the stress of negotiation, working in the background to continuously optimize the borrower's wealth.